The crypto timeline that's about to shock everyone isn't about price. It's about what happens next if you misunderstand liquidity over the next 6 to 12 months, because that mistake costs people entire cycles. Most investors think the damage is already done, but the real confusion usually starts after tightening ends, not before, and that's the part almost nobody is emotionally prepared for. You've probably felt it already. Those rallies that look real for 2 weeks, then fade. That sinking feeling when you think, maybe this was it, maybe the market is finally waking up, and then it slips right back into nothing. That's not random. And it's not because crypto is broken, it's because most people are staring at price while the actual engine of this market has been quietly doing something else. Let me put you inside the moment this really matters. Imagine sitting here 6 months from now watching crypto finally move, not violently, not with hype, but steadily, and realizing you spent this entire window either frozen or chasing noise. That's the outcome most people never see coming, because they're trained to look for fireworks instead of structure. The uncomfortable truth is that the last few years have not been chaotic. They've been brutally consistent. The reason it feels exhausting is because the signal hasn't been where most people were taught to look. And that signal is liquidity, not in a vague buzzword way, in a very specific, measurable way. One of the cleanest windows into that liquidity is something most crypto investors ignore entirely, the Purchasing Managers Index, or PMI. Now, before you tune out, because this sounds like macro jargon, stay with me. This isn't about economics textbooks. This is about why your portfolio has felt like it's stuck in quicksand, and why the next phase is going to confuse even more people than the last one did. Here's the part most investors miss. PMI isn't just a number on a chart. It's a monthly snapshot of whether businesses are expanding or contracting in the real economy. Purchasing managers are asked very basic questions. Are you producing more or less? Are orders increasing or drying up? Are you hiring or cutting back? Are suppliers speeding up or slowing down? When PMI is above 50, businesses are expanding. Cash flow improves, confidence rises, capital starts moving again. When PMI is below 50, everything reverses. Spending slows, lending tightens, risk appetite disappears. That single line at 50 has quietly determined whether speculative assets thrive or suffocate. Crypto is a risk asset. It doesn't live in isolation. When liquidity is expanding, crypto floats. When liquidity contracts, crypto struggles, no matter how strong the narrative sounds on social media. Now think back over the last few years with that lens, one of the deepest and longest PMI contractions in decades, longer than most people expected, deeper than many wanted to admit. And during that entire stretch, crypto kept trying to rally over and over again. Every one of those rallies failed, not because adoption stopped, not because the tech suddenly broke, but because liquidity simply wasn't there to support sustained risk-taking. This is where frustration turns into clarity if you let it. Those violent pumps followed by deeper sell-offs weren't fake markets. They were exactly what you get when capital briefly flows in, realizes the environment hasn't changed, and pulls right back out. That's what tightening looks like in price action. And here's the dangerous part. When you live through enough of those failed rallies, your brain starts rewriting the story. You start thinking maybe crypto doesn't work anymore. Maybe the cycle structure is gone. Maybe this time really is different in the worst way. That's the emotional damage of contraction phases. They don't just hurt portfolios, they distort perception. Now let me take you back to a moment that almost nobody paid attention to at the time, but ended up defining the entire next cycle. July 31st, 2019. The Federal Reserve officially ended balance sheet reduction. Quantitative tightening stopped the very next day, August 1st. On paper, that was the end of an active liquidity drain. Most people assume that should have been the starting gun for a bull market. It wasn't. And this is where expectations get people wrecked. After QT ended in 2019, crypto didn't explode higher. Prices stayed weak. Lower highs continued. There were still drawdowns. There were still moments where it felt like the market was rolling over again. That confusion lasted months. If you didn't understand liquidity, that period felt like proof that the market was broken. In reality, it was the final stretch of exhaustion before conditions actually improved. PMI was still contracting. Liquidity had stopped getting worse, but it wasn't getting better yet either. That difference matters more than most people realize. Ending tightening removes the brake. It does not immediately hit the accelerator. That's the nuance that separates patience from panic. Eventually, PMI stabilized. Then it started moving back toward expansion. Only after that did crypto respond decisively, not with one candle, but with a sustained shift in behavior. That's the sequence most people remember incorrectly. QT ended, struggle continued, sentiment collapsed, risk compressed, then expansion arrived. And here's why this matters right now. We're sitting in a very similar emotional zone. Tightening has ended or is ending. Liquidity is no longer being aggressively drained. But expansion hasn't fully returned yet. That gray area is where most investors lose conviction. They either sell too late or they wait for a confirmation that only shows up after price has already moved. This is where fractals help, not as predictions but as behavioral maps. In the last cycle, the period after QT ended was not the start of a new bear market. It was the final accumulation phase. The market felt heavy, rallies failed, downside risk still existed. And that's exactly why it worked. Because opportunity rarely looks like opportunity in real time. It looks like boredom, frustration, and self-doubt. Let me ground this with something concrete. Ethereum in 2019 is a perfect case study. After QT ended, ETH didn't bottom immediately. It fell from the low 200s down toward 100. That drop happened while many people were convinced the worst was already over. Risk metrics during that period collapsed. Single-digit risk levels, extreme undervaluation, the kind of conditions that feel terrifying when you're inside them. But when PMI expansion finally arrived, ETH didn't ask for permission. It moved hard. And it didn't matter if you timed the exact bottom. What mattered was being positioned during risk compression instead of waiting for price confirmation. That's the difference between risk-based thinking and price-based thinking. Price asks, what just happened? Risk asks, what's likely over the next year? And that's the shift most investors never make. Here's the question I hear all the time during phases like this. If downside is still possible, why not sell now and buy back later? On the surface, that sounds smart. In practice, it assumes precision most people don't have. Macro transitions are messy. The turn rarely announces itself. Miss it, and suddenly you're chasing higher prices or waiting for a pullback that never comes. Risk frameworks don't try to predict exact moves, they measure conditions. Historically, when assets sit at low risk levels during liquidity transitions, forward returns improve over longer horizons, even if volatility remains uncomfortable. That doesn't mean there's no downside, it means the balance of probabilities shifts. This is where discipline replaces prediction. Now there's another layer to this that doesn't get talked about enough. Crypto markets don't exist in a vacuum. Liquidity isn't just about central banks. It's about borrowing costs, business confidence, inventory cycles, and global stimulus. Lower rates encourage borrowing. Borrowing fuels expansion. Expansion shows up in PMI. PMI expansion supports risk assets. Inventory drawdowns eventually turn into restocking. Restocking increases orders. Orders increase production. Production increases cash flow. Cash flow increases risk appetite. That entire chain moves slowly, then all at once, and that's the part your brain struggles with the most. Humans are terrible at gradual change. When things move slowly, we assume nothing is happening. We assume stagnation. We assume the environment is stuck. But in macro cycles, slow movement is usually pressure building, not absence of motion. Businesses don't flip from fear to confidence overnight. They inch there. Orders stabilize before they grow. Inventories stop shrinking before they get rebuilt. Hiring pauses before it resumes. Credit conditions loosen quietly before they show up in headlines. By the time it feels obvious, the process is already well underway. PMI is one of the earliest signs that this shift is starting, not finishing. It doesn't tell you the party is happening, it tells you the doors are being unlocked. And that distinction is everything if you're trying to position rather than react. Right now, we're sitting in the most psychologically difficult place in the entire cycle, the uncomfortable waiting room between contraction and expansion. The pain of the downturn is still fresh. The relief of recovery hasn't arrived yet. Nothing feels resolved, but nothing feels clearly broken either. This is where uncertainty feels personal. And this is also where a lot of bad decisions get justified with logic that sounds smart in the moment. Not reckless logic, careful sounding logic. The kind that feels rational because it's wrapped in frustration. People start saying things like, I'll just trade this range until something happens, or I'll rotate into whatever's moving this week, or I'll sit in cash until it's obvious, because being cautious feels responsible. What's actually happening underneath is impatience. Overtrading creeps in because doing something feels better than waiting. Short-term narratives become attractive because they offer a sense of control. Jumping between assets feels like adaptability, but it's often just anxiety wearing a strategy costume. And the cruel irony is that this is exactly when long-term positioning quietly happens. Not loudly, not on social media, not with bold predictions. It happens in the background while attention is fragmented and conviction is low. Capital that understands cycles doesn't need excitement. It needs conditions to stop deteriorating. Now pause here for a second because this part matters more than people think. This might shock you, but I'm not a financial advisor and nothing in this video is financial advice. Cryptocurrencies are highly volatile and you could lose all the money you invest. You should always do your own research and consult a qualified professional. After all, your investments are entirely your responsibility, and you should know that nothing is ever guaranteed when it comes to investing. Neither I, this channel, nor YouTube are liable for any losses. And this video is for entertainment and educational purposes only. Back to the point that actually moves the needle. When liquidity tightening ends, the market does not reward impatience. It punishes it. It rewards preparation instead. Quiet, boring, disciplined preparation that doesn't feel impressive in real time. This is where mindset starts to matter more than strategy. Because two people can hold the same assets and experience completely different outcomes depending on how they interpret uncertainty. If you're waking up every day asking, why hasn't price moved yet, you're framing the environment as a failure. You're measuring success by speed. That mindset creates frustration, and frustration leads to forced decisions. But if instead you're asking, has the environment stopped getting worse, you're anchoring to structure instead of noise. You're recognizing that stabilization is a process, not a headline. That shift in questioning changes everything. There's a subtle but powerful reframe here that most investors never fully internalize. The absence of bad news is not the same as the presence of good news. But markets don't wait for comfort. They don't wait for certainty. They start pricing improvement while the data still feels awkward and incomplete. By the time PMI is clearly screaming expansion, by the time sentiment feels safe again, a meaningful part of the move is usually already behind you. That's not unfair. That's how forward-looking markets work. At the same time, pretending expansion has already arrived is how people overextend. They size positions as if liquidity is abundant when it's still fragile. They take risks designed for late cycle conditions in early cycle environments. That's how preparation turns into regret. The balance point lives in risk awareness, not optimism, not pessimism, awareness. Understanding where you are in the cycle doesn't give you perfect timing. It gives you emotional stability. It lets you hold through boredom without forcing action. It lets you respect downside without being paralyzed by it. And that's the skill that actually compounds over cycles. Now let's talk about something practical, because I know some of you are thinking, okay, but what do I actually do with this? First, you have to stop treating every rally like it's a verdict on the entire market. This is one of the most expensive mental habits in crypto. A green week does not mean the cycle flipped. A strong candle does not mean the macro backdrop changed. During transition phases, rallies are stress tests. They're the market asking a question, not delivering an answer. When liquidity is still fragile, rallies exist to see how much capital is actually willing to stay. Can buyers hold bids when price stalls? Do institutions add exposure, or do they fade strength? Does volume expand after the initial move, or does it dry up the moment momentum slows? Those answers matter more than the size of the candle itself. This is why so many rallies over the last few years felt cruel. They weren't lies, they were probes. The market pushed upward just far enough to test confidence, then pulled back when liquidity couldn't support continuation. If you interpret every probe as a confirmation, you end up emotionally overexposed. You go all in on hope, then all out on disappointment, over and over again. That cycle doesn't just hurt returns. It trains you to distrust the market at exactly the wrong moment. Second, you need to understand something that feels counterintuitive if you're wired for excitement. Real accumulation phases are quiet. They are emotionally flat. They don't feel powerful. They don't feel obvious. They feel boring, confusing, and slightly uncomfortable. If you're waiting for accumulation to feel exciting, you'll miss it every time. Think about what accumulation actually means. It's a period where capital is slowly positioning without urgency. There's no reason to rush because liquidity hasn't fully returned yet. There's no reason to advertise because sentiment is still fragile, so price moves sideways, volatility compresses, narratives conflict, and attention drifts. That boredom you feel isn't a signal that nothing is happening. It's a signal that the loud participants are gone. That's usually when positioning becomes asymmetric. Most people assume opportunity feels good. In reality, opportunity often feels dull. It feels like waiting. It feels like doubt creeping in. It feels like asking yourself why nothing is working yet. That's not a flaw in the process. That's the process doing exactly what it's supposed to do. Third, and this part is critical, you have to manage your exposure in a way that lets you survive uncertainty, not win big fast. Survive long enough to participate when conditions improve. This is where people confuse bravery with recklessness. Spreading entries over time isn't about being timid, it's about acknowledging that macro transitions are noisy. No one rings a bell at the bottom. By scaling exposure instead of swinging all at once, you reduce the emotional pressure to be right immediately. Focusing on higher quality assets isn't about ignoring upside. It's about staying aligned with liquidity. When capital returns, it flows to assets with depth first. Speculation follows later. If you position as if every phase is a late cycle mania, you end up taking late cycle risks in early cycle conditions. And leverage, especially here, is not confidence, it's impatience with consequences. Leverage demands timing precision at the exact moment the market is least precise. If you value sleep, clarity, and decision-making, this is the phase where leverage quietly removes people from the game before the real move even starts. Now let's talk about something unglamorous but essential. Infrastructure. Liquidity transitions stress systems. Exchanges see spikes in volume, volatility, and withdrawals at the same time. That's when friction shows up. That's when fees matter. That's when custody choices matter. That's when knowing how an exchange actually operates matters. If you're using exchanges, this is the moment to be intentional. Understand their KYC requirements before you need them. Know how withdrawals work when volatility hits. Be aware of fees, limits, and custody structures. Affiliate link or not, convenience during calm markets means nothing if access disappears during stress. This isn't paranoia, it's preparation. Now zoom out one more level. This phase feels uncomfortable because it sits between clarity and confirmation. The tightening phase created clarity. Everything was bad, and it was obvious why. The expansion phase brings confirmation. Growth shows up in data, sentiment improves, price follows, but the space between those two is messy. Tightening has ended. Expansion hasn't fully arrived. That gap is where narratives collapse. Bulls sound early. Bears sound convincing. Everyone feels slightly wrong at the same time. That's where emotions take over if you let them. History shows this is not where cycles die. This is where they reset, where excess gets cleared, where expectations recalibrate, where positioning quietly shifts away from fear and toward probability. The market doesn't exist to reward certainty. Certainty is usually highest near tops and bottoms, when people feel most convinced they understand what comes next. The market exists to punish that confidence, to move when conviction is weakest and preparation is strongest. The investors who come out ahead aren't the ones who nailed the exact bottom to the dollar. They're the ones who understood liquidity, respected risk, and refused to let short-term noise rewrite long-term structure. If there's one thing to carry with you from this, it's this. The crypto timeline that's about to shock everyone won't shock you if you're watching the right signal. Price will always be loud. Liquidity explains the silence before the move. Subscribe or watch the next video.